Okay, let's do another Q&A for the last market outlook. First comment, this was a particularly useful outlook. A little bit more, please. What made it particularly useful? If you tell me that, then I can do more of that. Next one, mentioned it before, but think you would enjoy having a peek at CNQ's earnings report as of late. That is Canadian Natural Resources, CNQ, listed both in Toronto and in New York. If you don't want the currency risk as a Canadian, just buy it on the TSX. Likely the best run Canadian E&P there is. Extremely shareholder friendly cash return policy. They do have a very significant dividend. It's like a buck something a quarter. I think they're just under $100 now, so it puts it at about a 4% yield. And it is, for Canadians, a qualified dividend, which means you qualify for a lower tax rate on that dividend. TMX expansion hitting its in-service date this year. I think we could see WCS WTI spreads shrink. Would like to hear your thoughts on it. Also being extremely generous in terms of IV for option selling. I looked at that. The options at the money is about 2.5%. So if you're selling, I think it's $99, selling a 99 put, you get about 2.5% on that. So the straddle's a 5% straddle, which is not bad. Usually trades in a band. Has not been trading in a band. It was for a while, but it's at a all-time high. All-time highs right now. So I think that the in-service date for the pipeline is probably already priced in. I don't know how Alberta will be treated in the years going forward in terms of that type of oil. It's a very heavy, sour oil. Heavy, meaning that it's going to be extremely expensive to get out of the ground. Sour meaning extremely expensive to refine. It's a dirtier oil. If we think about the term clean and dirty in terms of energy, it's a dirtier oil. It's marginal oil, basically. But yeah, CNQ is there. It does have a good return of cash to shareholders. I just don't, I'd rather be in the Permian with the light sweet crude as opposed to the other grades of oil. That does not mean they can't perform. It just means if I have a choice, I'd prefer to pick players in the Permian Basin. Let's see. Appreciated and successfully followed your advice on how to approach level 1 and level 2. Can you please break down the best way to approach the applied series? There is no best way. It is exploratory. There's no exam. I don't really think that you have to know something before you know something else. I think you probably could benefit from a little bit of the options, the applied options first before you do the portfolio construction. But the sector studies can be done at any time. It gives you a very good understanding of all the sectors and of some of the industries in those sectors. I think a great addition to applied series would be to follow along video for agency earnings call. Watch the last one, and sometimes the analysts ask market management questions where I'm not quite sure what they are trying to get at or the reasoning behind the question. Would love if you could do something like this, even if it's a live stream. So I have done an extremely long video on agency and understanding its business model and the tools that it uses. When you're listening to a conference call and the analyst's asking questions, that is where you have to do some of your own research. Google is right there for you. Discover it. You really do have to put in some of the time yourself. I can get you most of the way there, and the videos that are up can get you quite a bit of the ways there in understanding the industry and understanding the 10K. But there will always be an analyst who has a very specific question about a line item. Take the time, Google it, see what you can get on your own. That would be my recommendation. It would be difficult to do this every quarter. As I keep expanding the number of industries, there'll come a point where, I've covered 50 different companies. It would be a full-time job for two people to do four, because every company has 4 calls a year. You're looking at 800 calls a year if you have 50 companies to keep up on all 50 to review their quarterlies. You're doing 800 a year. No one human can do that. It's just way too much time. That would give you 4 hours to get it done. It can't be done. So you'd start building staff, and if you're building staff, well, then the price is too low. The price has to go up significantly, which means the market opportunity is much smaller. So then I can't target a retail investor. I have to target an institutional investor who's willing to pay, $7,000, $8,000, $9,000 subscription costs per year to get that done. That's the only other way to get it done. So those things do have a real cost. My son just turned 18. I want to encourage him to start chipping in every month in a very long-term portfolio, compounding new additions, gains, and dividends as years go by. Question is, given his ultra-long investing horizon, would you build a simple portfolio with, say, 4 basic asset classes and rebalance yearly, or would you just pick a broad equity index? Given his young age, I think his fixed income allocation would be extremely low. I don't know that I would, put them all in high risk, high beta stocks, but the S&P 500 broad equity index, I think, is all that needs to happen right now. At 18, I don't know that you really need much of a bond allocation. If you do, 10%, given the yields that exist today, maybe even 20% or 25%, and when yields do drop and prices go up, you can sell out of those that allocation, bring it back down to 10%, and add the 15% to the equity allocation. But I would take a broad equity index for now at 18, and by the time they're 30, then they can start thinking about what their goals, their financial goals in life are, and come up with a better allocation. But I think I would ignore the commodities and gold for now and just focus on a broad equity index. Missed your comments on housing stocks and mortgage stocks. Do you still own Arbor? Yes, I do. If yes, why is it drifting lower? Because it has exposure to commercial real estate, and it will suffer like everything else that has exposure to commercial real estate. It will not get that much credit for better management or a different market niche in the commercial real estate sector, or for operational performance going over the last 2 years of a rate hiking cycle, being able to raise the dividend 3 times during that period and buy back stock. It's not going to get credit for that because it is just broad bucket thinking. You have commercial real estate exposure, especially in multifamily, I'm out, and that's it. That Arbor will have to sing for its supper every single quarter. As long as I've held this stock, it just doesn't get respect from the market. It's performed very well, but it has to perform. It has to sing for its supper. It can't just say things are going to be great and the market goes, oh, they said things are going to be great, up we go. It's not a Tesla, it's not NVIDIA. You can't just say things are going to be great. You actually have to prove it each time. And I think they'll have to continue to prove it each time. But in the meantime, it's a beautiful dividend. Is sound portfolio management uncorrelated asset classes with uncorrelated option strategies on these? You do, if you want diversification, diversification comes from lower and lower correlations. But it's very difficult to build an alpha portfolio. Alpha portfolio meaning that everything is uncorrelated with everything else. You're going to have either a very broad duration or a very broad beta component to everything you have. Getting zero correlation is going to be, it's very advanced to get that and very hard to get that. But that is the goal, is to try to find strategies that are, less correlated with the other things that you're doing. Should one strive to use all their portfolio margin? Well, when you say margin, let's make sure we have the same definition of the word. Margin is me. It's my money. So if I have $10,000 in my trading account, my margin is $10,000. That does not mean I have a margin loan. My margin is 10. I have 10. Margin is me. So what you're asking is, does it make sense to be fully invested? Well, yes. Even if you have 50% invested in equities and 50% in cash, that cash is going to be in T-bills, which means you're invested. That's 5.5%. But just to have money just sitting there, that doesn't make a lot of sense. Put it in some kind of fixed income security, some kind of money market security. One of your videos in the applied series, you show graphs of dividend yields on a couple of ETFs. On what platform you use? That's Koifin. Exactly. Can you please talk about assignment risk in puts and calls? That's a big question. I don't know exactly what you want me to talk about. Is there assignment risk when you're short calls and short puts? Yes. Beyond that, I don't know what you're looking for in that question. The risk exists more so for puts than calls at high interest rates. The higher the interest rate, the sooner I would like to get my money, because then I can put my money in a money market fund paying 5.5%. So if it's 30 days to expiration and I can put it to you for 100, and the time value, I can compare the time value with what I would get in a money market fund for the next 30 days. The higher the interest rate, the more likely I'm going to do better by getting my money today and putting it in a money market fund. So I'd be more willing to put it to you sooner with higher interest rates, and probably call later, because to call I have to pay you money, but my money's earning 5.5%. So at higher interest rates, puts have higher assignment risk, calls have lower. Beyond that, I'm not quite sure what aspect you want me to comment on. CFA Level 1 course, are the readings considered the videos you publish? Yes. Yes, there is. Yes, it is. Portfolio management module. Do you envision adding more videos? Yes, I do. It's not complete. It's complete for the amount of time that I had. I think there's like 21 different videos in there, 21 weeks. But yeah, I do envision adding more. Mosquito problem in your back patio. I found overhead outdoor ceiling fans to be the best deterrent. Yeah, my outdoor isn't built that way. That putting outdoor fans is just it's just not going to work the way it's built. So, but I am looking at putting some fans in. Oh, speaking of fans, I'm a big fan. Always been watching your content the last 5 years. Helped me pass all 3 levels. I have a friend, a colleague, who is obsessed with technical analysis. Oh, you're asking for a friend. He attempted to chart TLT, but I don't really believe there's any value in using technical analysis for fixed income securities. I don't think so. I agree. I don't think so. I know you're not a fan of TA at all, but can you see any value in using TA for a bond-backed ETF? Well, the ETF is not going to deviate from the yield curve. Period. So the ETF, drawing a chart on ETF is meaningless. It's like charting your shadow and saying, well, the shadow is going to move left any minute now based on its pattern. It's like, well, the shadow is a reflection of me. You should be charting me, not the shadow. TLT it doesn't have its own behavior. It behaves like its portfolio, so no, I don't. Well, first of all, let's get it down to the core basics. I don't see any value in TA at all. When you have fundamental data for your underlying, I see no value in technical analysis at all. Flip a coin and you'll do just as good as technical analysis. But for TLT, no, it's driven, the price of TLT is driven by the yield curve. So, paying attention to TLT to figure out what's going to happen next is like watching my shadow to see where I move next. Why not just watch me, right? You mentioned in the establishment survey, healthcare social assistant jobs do not contribute to potential GDP. Why is that? So there are high productivity and low productivity jobs. Some jobs are just will cut into labor productivity. In other words, they reduce the overall labor productivity in the economy. They pull down labor productivity. And if you do that, that becomes inflationary. That's the inflationary drive in wages and in prices, is when you have very low or even negative labor productivity. And then some jobs really boost labor productivity. So IT jobs can really increase the potential GDP of an economy because they are high productivity jobs. Some of the lowest productivity sectors are health and food service, food and accommodation service. And that's where we saw a lot of the jobs being added. So let me give you an example. Let's say that the cost, this will add to GDP. It just does not add to potential GDP growth. So you have to think of the difference between the two. There's GDP and GDP growth. It's like thinking about your wage, right? You can get a raise that year, but you may not be doing anything to yourself to increase the growth in your wage. So you may get 1% increase each year, which means your wage is going up each year, but you're not doing anything to improve yourself to make your wage go up 3% a year, for example. So healthcare will add to GDP. Spending on healthcare will add to GDP, but it does not add to GDP, potential GDP growth. Think about spending $1 million on an 82-year-old that has cancer over a course of a year to cure that particular cancer. That does not increase the productive capacity of the economy at all. Think of a social worker, which is a very low-paid job. Counseling an at-risk youth. That does not contribute to the potential GDP of the economy at all. Same with food and accommodation workers, very low-paid jobs, very low productivity jobs. They actually take away from the productivity of the economy. So if we think of real GDP, GDP is our nominal GDP minus inflation, and low productivity jobs, if they drive productivity down, that actually drives inflation up. You can see that if it does not increase nominal GDP by more than the rate of inflation, it has no effect on real GDP. So if we look at just the last 4 or 5 months, we've seen decreases in IT jobs, but our increases are in lower paying jobs and decreases in higher productivity jobs. Think about a job in construction where you're building out infrastructure, for example, or where you're creating new structures or new buildings. Think about jobs in capital goods, in providing goods, capital goods. While you produce these capital goods go on to increase the productive capacity of an economy. That is just not the case with healthcare and food and accommodation. It does not increase the productive capacity of an economy. The only part you get out of it is the wage. But again, this wage, being that it's a low-level wage, actually drives down productivity, which does boost inflation, which, given a constant nominal GDP, would drive down real GDP. Regarding MBS, when rates go up, prepayments go down, correct? Which means the market value of the bond will stay elevated. Well, no. No, it will not stay elevated. The principal outstanding will stay elevated. But let's think about a timeline. Let's say you get a principal payment over here. And let's say you had an increase, that you were getting small little principal prepayments all along here, and you had an increase in wages, and all these disappeared, so that this principal balance wasn't reducing anymore. Well, time value of money says the higher the interest rate, the lower the present value of that particular cash flow is. So no, it wouldn't stay elevated. The principal outstanding would stay elevated, but remember the three rules of money here. Safer money is worth more, money sooner is worth more, and larger cash flows are worth more. So if you have your interest plus principal plus prepayment, that is a larger cash flow. And if you're getting that sooner, that is worth more. Well, if you take these off, you have both a smaller cash flow and a later cash flow. So that means they're worth less, so it wouldn't stay elevated. This also means duration will increase. Duration does increase. Value of the bond decreases, correct. Which has more an effect on the value of the bond? They both do. So just your first statement was incorrect. So when rates increase, these things do decrease in price. How do you adjust your put selling as the stock price continues to go up? Oxy, for example, earlier this year, bouncing around 56, 57, it's good to sell 55 puts, but now sitting around 60, 61. That's true. You can move up your puts. You can move them to 60 to 57.50. Given the consolidation going on, especially for companies in the Permian Basin, and given that the acquirers are more than likely to shut down wells, low production wells, you actually will have a decrease in oil production going forward, not an increase, which will support prices a lot better. So yeah, there are times where you would have to increase your put. You do have to follow it upwards. My thinking is on any weakness down into the 50s, the 57, 50, 55, sell. And when I was selling them, it was 50 to 100 at a time on the puts, because I had no problem accepting them. So my conviction just grew. So if I were going to sell 60s, I might sell 25 at 60, and if it drops down, I might sell 50 at 57.50, and if it keeps going, I might sell 100 at 55. Laddered that way, increasing the quantity of my puts as the price went down. Moving on from indices, I'd like to sell puts on some individual stocks because they offer higher premiums. Sure. I look to sell puts on stocks from different industries for diversification. Okay. What quality should I look for in companies when I care about lower risk over growth and also look to generate premiums? Companies that are well supported. Companies that, if you're looking at a stock chart and you see a stock that's just gone like this, that's a dangerous one to sell puts on. Like Nvidia is just dangerous to sell puts on. But deep value companies are fantastic to sell puts on because you don't mind owning them at that price. So AT&T is a good one. I think at $17, it's a nice place to sell puts because it has enough to support 17, much below 17. That dividend yield is just too nice. And other market participants will think the same thing. So just think, would you own it at that price? And if the answer is yes, that's where you sell puts. If you would own it at that price anyways, you go ahead and sell puts. That's what I look for. Is a stock where it's cheap. Doesn't mean it can't get cheaper, but it's more likely to get more expensive than cheaper. And if it does get cheaper, you'd own it anyways. Would entering sectors with strong asset base like banks and real estate be ideal? Well, it really depends on what's going on in the economy. Real estate, I take a pass on that one. But good, strong asset base. Again, you go to AT&T. The network is everything. The network is the whole. It's the whole digital economy's network, and the economy can grow only as fast as the network can do it. If you cannot get faster throughput than what we currently have now with 5G, if millimeter wave technology just doesn't pan out, if there is no 6G coming, that's it. Some ideas that we have for businesses only work with higher data throughput. Everything is the network. So something like AT&T is just a nice target, not a sexy target at all, but it's nice because you need that network. Period. You need the network. It will always exist. Also vaguely recall you mentioning in one of your past videos that you can beat the S&P with just 5 of its constituent stocks. Could you please elaborate on that? Give me 5 stocks. Just give me 5. I want implied volatility between 20 and 30%. I want value stocks, but I need that volatility implied between 20 and 30%. I'll buy those 5, and I will sell puts on it, and I can do 20% on 5. That wouldn't be difficult to do. I don't know what 5, right? But I mean, if I were challenged with it, with a very decent payoff, if I won, not just for bragging rights, then I probably would do it. I believe you mentioned that you'd have to move to cash until you settle in Costa Rica. That is true. Well, I mean, it's not that I have to move to cash. To get out of Canada into the U.S., I had to move to cash. Not all cash, fixed income basically. Fixed income, combination of fixed income, money market securities and cash. I'm not a permanent resident of Costa Rica. I'm a temporary resident, which means I cannot set up a brokerage account until I'm a permanent resident. But the waiting went from, it was like 8 to 10 months, has now gone from 14 to 18 months. So it might be a whole year before I become a permanent resident. What do you recommend for those of us moving out of our home countries to another location that has lower taxes? I'm considering moving and not sure if I have to cash out and start over again. Well, you don't start over. You cash out at where you are. With my investments, and think about what strategies work best. Well, anywhere you are, if you have any retirement or tax-free savings accounts, you don't have to close those. Assuming I can't time the market, do I start with selling puts for the stocks I want to own? This is a hard question to answer because I don't know enough. What country are you going to? How long is it going to take you to get residency? Can you move to that country? Do you have the money to actually get into one of the in one of the residency categories? The golden visas are the best, meaning the investor visas are the best, which means you're going to have to spend some money on something. So I don't know what your time frame is or how long it's going to take you or what country you're going to. So I have no way of answering that other than saying you must be a resident somewhere to open a brokerage account. What causes negative correlation between 10-year Treasury rates and MBM prices? It is yields up, prices down. If yields go up, the price of money goes down. If yields go down, the price of money goes up. That is all it is. Concerning the higher year-over-year corporate bond issuance level, could also be the companies are issuing more debt to retire old debt or meet balloon payments of maturing debt. Well, sure, it could be. It could be, but these are outsized issuances. Unless there was several issues all maturing at the same time. I mean, sure, it could be. I'm also surprised that convertible bond issuance is not really a big thing. Convertible bond issuance is usually for smaller companies, high yield companies. So high yield, riskier companies to entice a bond sale will have some extra features like convertibility. And it could just be that it's not a very good market for those smaller companies, those higher risk companies, that even the convertible feature isn't enticing them. Or the other argument is it's just so easy to issue high yield debt that you don't even have to add the convertibility issue. Maybe go the other way. Given where spreads are and the amount of issuance, why should I add convertibility? I mean, I can float a high yield debt issuance with just a secured issuance of 5-year. I don't even have to, enrich it with a convertibility option. That could be it. Perhaps the tight, even though it could be a great tool for troubled companies to avoid high interest rates. No, it's not. The convertibility issue is an option for the holder. So if the company's not doing well, the holder would never convert. The holder will want their money back. It's only when the price of the stock rises above the convertible price or the conversion price that the company can then force conversion if the price stays above a certain number for a while. But beyond that, it's the investor that chooses. Perhaps the tight OAS spreads are preventing convertible bonds from being a useful tool. Yeah. Continued lower real yields, high probabilities of lower future rates. Gold continues to keep hitting all-time highs. Do you think we could see these gold stocks, which have been undervalued for a long time, move up? Gold miners are up 10% in the past week. Well, I think you've answered your own question. Do you think we can see them go up? They're up 10% in the last week, so I guess yes. Yeah, I guess. Gold miners, keep in mind, once you get to a company, if you're using a company to make a bet on a commodity has no income statement. Companies do. Companies have unions, they have mismanagement, they have malinvestment, they have all sorts of things. So it's got to be a very well-run company. So you have to think about that, not just the price of gold. Let me buy gold miners. But yeah, they'll move up, but they'll also move down. I think yesterday gold retreated. I think this morning when I checked, gold was retreating. Let's have a look here. Look at copper. Isn't that beautiful? 405, breaching the $4 mark. Where is gold? Well, gold's up $13.90. It was down, I think, in pre-market earlier today. It was, let's see, 2 days. Yeah, yesterday. Sorry, yesterday it was down 21.60, recovering today. Having trouble at the 22. Gold miners will be highly correlated with the price of gold. In your applied series playlist, you show the application of many concepts from the CFA program, but I'm not sure you've shown the application of modern portfolio theory. Do you not use those concepts? Not really. Like to do a mean variance optimization? Not really. What would be the point? I know it's a popular thing at the institutional level, but I'm going to have to forecast expected returns of asset classes. I'm going to have to forecast volatilities of asset classes. I'm going to have to forecast correlations between all the asset classes. Forecast, educated guesses. And if I pile in a whole bunch of educated guesses to an MVO, it will give me the weights on each asset class. And these weights are built on a mountain of assumptions, on a mountain of best guesses. Change these just a little, change these just a little, these all change. Those all change. So it is, it's your best guess. Well, why not just make a best guess? Why not just say, well, I'll be 55% equities, 30% fixed income, 10% commodities, and 5% crypto. It's just make a best guess. It's just as good as any other guess you'll make. So it's just built on a mountain of guesses. So no, I don't really show it. If the corporate bond issuance date is for January and February, we wouldn't know if it was spent on CapEx or share buybacks until the first quarter. Pretty much. Could you explain why Treasury auctions consider significant market event? Well, let's say that you're looking at the 30-year, and the 30-year is yielding, let's say, 4.3%. 5 minutes before the auction, and the auction happens, and the auction clears at 4.4%. These market bonds that are yielding 4.3 will adjust to 4.4% very quickly, so the price will drop very quickly. So the new issuance has to go out at least the same or lower yield than where the market is just before the auction announcement is made. Regarding gold, what are your thoughts on gold miners? Already talked about that. What are your thoughts on copper production cuts from Chinese smelters? Yes, that was beautiful today, wasn't it? A couple of or some of the Chinese smelters that weren't making any money decided, let's just shut down or cut back production. You have low supply right now, and you had a build out of smelter capacity. So you had a lot of smelters that had to compete for a smaller supply of ore. So it was great for copper miners because the amount of paid metal would naturally increase if the smelters have to compete. So it was a problem for smelters, not so much for copper miners. With a couple of them shutting down, the belief is that, well, you'll take some of the copper supply off the market. I don't think you will, because you had overcapacity in smelting anyways. But being that it is a nice pop in everything today, if you were thinking about, well, is this sustainable for long term? I don't know that it is. That I'd probably be looking at selling, if I had 5,000 FCX or something. If I were selling puts and some of them were assigned to me, this might be the time I'd be thinking about selling the $44, $45 calls. The 52-week high on FCX is somewhere around $44, 42 and change, pushing the 43. I got my system here. Let me just open it up and let's see where we are on FCX right now. That would be under here. FCX 43.65, up 8.15%. What makes FCX such a great play right now is gold is going up at the same time. So when you have gold going up out of Indonesia, its copper mines produce a lot of gold, so much so that by the time it sells its gold, not only is its copper free, its copper has a negative cost, and the price of copper is going up. So Freeport's doing very well. It has a 52-week high of 44.50. We're at 43.60. Might be a good time to, if you wanted to lighten up on FCX, if you wanted to lighten up, to sell the 45s. 30 to April 19th, 37 days. 45s are yielding, well, you can get them $1.50. That would make your exit at 46.50, which is $2 above its 52-week high. So yeah, it's nice if you wanted to lighten up on your copper miners at this point, because I think it's not going to take the market long before it says, well, hang on a second. You had smelters shutting down, but you had overcapacity anyways. This isn't going to change the supply of copper onto the market. I mean, you're not going to have a shortage of smelting capacity, but because China didn't say how much capacity they're shutting down, it could just be an announcement. I mean, it just could be an announcement with little follow through. So it would be, an opportunity, I think, to say, well, I didn't really want 5,000 shares. I only want 3. Let me sell 20 calls at 45. If they get called away, I get 46.50, $2 above the 52-week high. That's not bad. Is there a portfolio size where you see options plays are no longer an option? No. You just size them. You say if your portfolio gets bigger, you move from 1 to 2, 2 to 4, 4 to 8, 8 to 16. Pretty soon you're selling 50, and 50 is so small it doesn't move the needle. You're selling 100. So no, I don't think so. If I opt for an out-of-the-money calendar spread, out-of-the-money calendar call, a calendar call spread, a calendar spread with calls, I think is what you mean, instead of at the money. Will it simply shift the payoff to the right while keeping the payoff shape the same? Well, pretty much. Well, I'm confused now, right? Do you mean a calendar spread or a call spread? Because you're saying a calendar call spread. So I don't know if you mean a call spread or a calendar spread, or a calendar spread using calls. How does it impact the width of the break even in the scenario? The width, okay, so you must mean a call spread, not a calendar. Well, yeah, I guess I can't answer this question, because the second part of your question suggests to me that you're talking about a call spread, but you clearly are using the word calendar in there, so I can't answer that one. Please upload Fed balance sheet video and the sector studies of the applied series before March meeting. It would be very helpful. It's detailed. That thing is a monster. It's long. I don't know if I'll be done by that time. There is so much to go through to understand the balance sheet, and then you almost have to go through it. I can't just go to the transactions. And for the transactions, you can't just think about one transaction. You have to think about, well, what happens all the way through the system from the investor? And you have to look at the transaction that an investor takes and what the brokerage would do to the bank, what the bank does to the Fed, and then how the Fed records it. So it's just very long. But here's a simple way to think about it. If the Fed's assets go down, its liabilities must go down. Its liabilities, it has three big liabilities. Forget currency. Forget the currency in circulation. That only goes in one direction by about 6% a year. You have the TGA, which is the Treasury General Account. They're targeting around 750 billion. You can pretty much just forget about that. So you have the reverse repo, and you have foreign and others. Just look at the others category, and you have reserves, right? And if assets drop, it's usually these two here that you would expect to see the drop in. Or if the drop is in these two, then there is a limit to how far down you go. Once this is zero, then it's reserves that drop. And as soon as you get to about 2.5 trillion, that would be a hard stop, I think, for the Fed. So I don't think they're going to run off and then just stop at 2.5. I think they're going to run off and slowly taper that runoff so that they can run off longer and then simply just end it when they get to 2.5. I think they'll look to extend it out for as long as they can. But the full video for the balance sheet, it's detailed. It's quite long. Very rich contents from this week's market outlook. Hasn't been so comprehensive for a while. Well, what exactly was it, so that I know? How do you feel about ABR Agency? I like them. The dividend is solid. The cash flow is solid. They have the cash to pay the dividend. If you look at the cash flow, their cash flow statements, they do have the cash. You can sort of engineer earnings and manipulate balance sheets into the quarter end date, but cash is hard to mess around with. You either have the cash or you don't. And the cash flow statements are solid. What are your thoughts, if any, on Elliott Wave? Colossal waste of time. Colossal waste of time. Anything theoretical that is that complicated with that many if-then statements and that many conditionals. The second leg is longer than the first and longer than the third, and it's like and all the recursion and each no, it's just a pile of nonsense. How much QE do you think is left on the Fed's balance sheet? Well, if you mean QE, that is the SOMA. The proceeds of QE is in the SOMA. We know that's about 6.9 trillion. But they're not going to 6.9 trillion. I think you mean how much QT is left. I think about 1.5 trillion of runoff is left. Does agency finance their MBS based on face value or market value? Okay, face value. Would be market value. That's how the dollar roll works. That's how you can go long or short MBSs with the dollar roll. Is you're buying or selling the front month, buying the back month, and you're hoping that the price of the bonds drop. And because you're selling $1 million and buying $1 million, you're hoping that when you sell the $1 million, the price drops, that when you buy the $1 million, you end up buying more bonds. You end up getting more bonds back. If you could only afford to buy one section of the applied level at a time, which one would you pick? Probably sector studies. Japan's GDP was revised upwards so they avoided a technical recession. That is true. Why is Nikkei down 2% in light of the news? Well, you got to look at the currency, right? If you have a decrease in currency, for a foreign buyer in terms of US dollars, if the yen is decreasing, the Nikkei is becoming cheaper and cheaper for a US buyer. As it's increasing, you're going to get some unwind of the carry trade, and it also makes it slightly more expensive for the US, for a US investor. And a US investor holding the Nikkei in yen has to be aware that the price, actually, never mind, let's back that up. If you were going in and the currency strengthened, even if the price of the index has not changed, the multiple becomes more expensive for you in US dollars. Isn't BOG abandoning YCC a good thing? Not really. It's just going to make interest expense for the Japanese government that much bigger. It may be, it's a thing that will have some outcomes, but whether it's a good thing or not is yet to be seen. Do you think INEA is a good ETF to buy as a long-term investment? I'm worried about its exposure to the rupee. I see that over the past 5 years, the U.S. has appreciated significantly against the rupee. I'm worried that this trend will continue. Well, that is the risk. There is nothing without risk. I cannot hand you a home run and say there's no risk in this home run. The only thing I can hand you to say there's no risk is a 30-day T-bill or a 90-day T-bill. Here you go. But there's risk in everything. So you have to assess the probability of that happening. But that is a risk. You have equity risk and currency risk wrapped up at the same time. As an aspiring retail investor, does it matter if I'm in the same time zone as the market I invest in? Nope, I'm not. In the Asia Pacific region, want to invest in the US. Well, that's going to be late nights for you or very early mornings. But it doesn't matter. Just your day shifts. Yeah, if you're investing, well then it's not like you're sitting there staring at all the lights flashing on your screen for 6.5 hours. That's a fool's game. Or what is it, 7.5 hours? 6.5 hours. U.S. equity valuations are stretched, though would you agree, when you word questions that way, though would you agree that the current administration would help supporting the markets at least until elections? Well, when you say the current administration, that's political, which means the Democrats. Would the Democrats help support the markets? I don't know how they would do that, at least until the elections. How would they do that? No, I don't know that I would agree on that. I'm not. If you give me some examples of something, saying, well, they could do this or they could do that, I don't know what they could do. But if you meant it in terms of the Fed is not the current administration. The Fed is, in government but separate. Why does healthcare not? Oh, well, he answered that. Random question: was your favorite movie and TV show? So this sounds like somebody who has my email address and saying, okay, well, let's figure out what his password question might be. I'll pass on that. So I don't think that really matters what my favorite TV show and movie is. But you got to be careful about giving out that information, because next week he'll come back. What was the name of your first girlfriend? What street did you live on when you grew up? What's your mother's maiden name? What's your PIN number? What's the password for your bank? Yeah, it's little by little, right? Build your profile, or build a profile. So I'll pass on that one, and takes us to the end of the week.